Do you know how to handle bad debts on your tax return? Wondering if you can deduct that unpaid invoice? And what's the difference between accrual and cash methods when it comes to bad debts? All this will be broken down in this video, so stick around. And if you've been looking to learn how to move towards tax-free living, click the link down in the description to sign up for my tax-free tax tactics talk that's coming up. If you've ever wondered how to lower your tax bill legally, this is the webinar for you. See you there. Hey there, tax warriors. Welcome to JDB Tax. I'm Bryan, enrolled agent and tax strategist, but I call myself a taxtician, a tax tactician leveraging the tax code to build your financial fortress. With this segment of Tax Tactics, we're tackling the topic of bad debts and how they can impact your tax deduction. If someone owes you money and you can't collect it, what can you do? Well, if you stick around, you're going to find out exactly how to handle those bad debts on your tax return. And if you'd like to see more tax content like this, hit the like and comment down below. So, someone owes you money and you can't collect it. First, let's define what a bad debt is. If someone owes you money and you can't collect it, you have a bad debt. And for businesses, this usually comes from operating activities like credit sales to customers. To claim a bad debt deduction, the amount must have been previously included in your income. You don't have to wait until a debt is due to determine if it's worthless. A debt becomes worthless when there's no longer any chance the debtor will pay the amount owed. For tax purposes, you can deduct the debt once it's clear that it's uncollectible. The method of accounting you use affects how you handle bad debts. If you use the accrual method, you can claim a bad debt deduction for amounts previously included in income. However, if you use the cash method, you can't claim a bad debt deduction because the income isn't recorded until it's received. To record a bad debt, you need to have made reasonable efforts to collect the amount due. For example, if you sold goods or services on credit and the customer hasn't paid, and after a reasonable period and efforts to collect, the uncollectible part becomes a business bad debt. If you claim a deduction for a bad debt and later recover all or part of it, you must include the recovered amount in your gross income. However, you only include the amount you previously deducted. Report the recovery as other income on your business form or schedule. And remember, for tax purposes, you can't anticipate or estimate expenses like bad debts or warranties. The expense must have been actually incurred before you can deduct it. Let's recap the key points. Bad debt is the money owed to you that you can't collect. Now, the accrual method allows you to claim the deduction if the amount was previously included in your income. Now, with the cash method, there's no deduction allowed because the income wasn't recorded until it's received. And as far as recording goes, to deduct the debt when it becomes clear it's uncollectible. And for the recovery, include recovered amounts in gross income limited to the amount previously deducted. There you have it. Understanding how to handle bad debts can help you manage your finances and maximize your tax deductions. Understanding business bad debts is just one of the many ways JDB Tax Strategy helps business owners legally save money on taxes without fear of the IRS, but leveraging the tax code to the fullest extent. After booking a consultation call with us at jdbtax.com, we'll build a personalized battle plan to minimize your tax burden and maximize your wealth. So subscribe, hit that notification bell, click all to join me on this epic quest to conquer taxes, claim your financial throne. I post tax tactics every Tuesday and Thursday. See you next time, tax warriors.